If you see on Polymarket there's a 4% chance Jesus Christ returns before 2027, the first reaction is usually, 4%? What? We all know that's not happening. That's free money. And that reaction is exactly why this is a great market to learn from. Because the mistake is treating that 4% number like a pure belief poll. It's not. It's a price. And prices are not just about what do I think happens. They're also about how long your money is tied up, what else you could earn instead, what risks you take while holding the trade, and what return you demand to participate. So, let's break it down in plain English. On a prediction market like this, a yes share pays $1 if it resolves yes, and $0 if it resolves no. So if yes is trading at 4 cents, people say, that implies a 4% chance. But even more important is the other side. Because the other side, no, is trading around 96 cents. And that means if you buy no at 96 cents, and it resolves no, you get $1 back. So your profit is 4 cents on 96 cents. Now suddenly, this doesn't look like I'm betting on theology. It looks more like I'm locking up capital for months to earn a small return with some risks attached. That's the key mindset. You're not asking if Jesus is returning. You're asking, if I'm almost sure this resolves to no, what yield do I require to hold this until expiry? That's a completely different question. And this is where opportunity cost and time value of money come in. If your money is tied up in this no position, that money can't be used elsewhere. So, what's your alternative? Maybe you can hold cash. Maybe stablecoin yields. Maybe short-term treasuries. Maybe another low-risk trade. If those alternatives are paying attractive returns, then holding no at 96 cents for a 4-cent payout might not be good enough. So what happens? People won't want to buy no unless the return improves. How does the return improve? No has to get cheaper. And if no gets cheaper, say from 96 cents to 95 cents, then by definition, yes goes up from 4 cents to 5 cents. So the market suddenly looks like the chance of Jesus returning went from 4% to 5%, even if nobody changed their actual view on whether Jesus is returning. That's the important part. The price can move because of financing logic, not because of a change in belief. So, when people say, wow, the chance went up, sometimes what really happened is no holders demanded a better return because competing, near risk-free yields went up. That's why these markets can confuse people. They look like a probability meter, but they also behave like a yield instrument with weird tail risk. Now, one quick caveat. In reality, you also have oracle risk, meaning the market doesn't resolve itself magically. It depends on how the platform defines and settles the outcome. So technically, even if you think the real-world event is impossible, you still can't treat the no side as a perfect 100% certainty. There is some contract and resolution risk. But for the sake of this explanation, we can mostly ignore that and focus on the main idea. Capital is not free. And this is why free money trades usually aren't free. Yes, the event may feel absurd. Yes, you may be extremely confident it resolves to no. But if you buy the no side, you're still making a decision about return on capital, lockup period, liquidity, and what else your money could earn. So the correct framing is not, why is the market saying there's a 4% chance Jesus returns? The better framing is, why is the market requiring roughly this level of compensation for someone to take the near certain side of this bet? That's a much more useful way to think, not just for weird prediction markets, but for finance in general. Because once you start seeing prices this way, you stop asking only what do people believe, and start asking the better question, what return do they demand to hold this risk? And that's where the real signal usually is.